Good afternoon. Probably say, welcome back, Craig. You know what? I dropped off the face of the planet. What can I say? Anyway, hey, good afternoon. This is Craig Modelmog for this week's episode of Wall Street X's and O's. Today is Friday, December 11th in snowy Fort Collins. You know, I'd start singing Let It Snow to you, but I wouldn't want you to shut this off right now because I've got too much to say today. So anyway, I am going to not sing. Not right now. I might later. I might get a wild hair and just start singing. You know how I am. But anyway, to kick things off, the normal disclosure. The opinions and information on this show are mine. The facts are facts. Although I have to say there are things that I have pulled up from other institutions and sources. Is where I source my facts. But as you know, I pride myself on really focusing on the facts. This is not a solicitation to buy or sell anything. Investments can and will lose money, and investments are not FDIC insured. So without further ado, we got a great show today. We're going to hit on unemployment. Why? Because we have to. It's a big part of the economy. Actually, not as big as one may think, but it's still a big deal. We're going to talk about the dollar. Ooh, yes, the dollar. We're going to talk about global macro strategy as a whole, on really what it is and how I use that from a standpoint of investment decision making. Then we're going to talk about decision making. I know we're really going to get in the weeds today, and I love it. But to kick things off very quickly, unemployment, not a good week. If you remember a couple weeks ago, I said probably, or from a probabilistic standpoint, we would see unemployment start to tick up with the onset of COVID coming back. Bam! That's exactly what happened. Okay, we're seeing closures going down. We're seeing businesses start to shutter again. We're seeing the impacts of COVID really hit a lot of your restaurants, a lot of your retail, anything in public. And you know, the result was we saw an increase in initial claims of 137,000, which was an increase up to 153,000 for the week, which was the highest level in 10 weeks. 10 stinking weeks. Okay, private or pandemic unemployment claims, PUA claims, spiked to an 11-week high of 428,000. So you know what? Things are happening again. It wouldn't shock me, again, as I've stated all along, that we see unemployment elevated for an extended period of time. It's going to take time to work through this. Okay, all the more reason our government, Democrats and Republicans, need to come together and work a deal. If I'm a betting person, of which I'm going to be, they will get a deal done before year end. Neither group wants to go out this year with the perception that they were the cause of a deal not getting done. Because if you also remember what I've been talking about, as of December 31st, lots of things on the unemployment, the pandemic unemployment stuff, the CARES Act, a lot of these things stop. And we still have a lot of people that are hurting right now. So, in and around the holidays, here's what I would ask. Shop less for yourself. Find some local charities in town that are taking care of people in need. And instead of buying Christmas presents that you're going to forget what you got in 6 to 12 months, give it away. Give it to people that need it. Okay, that's what we need to do. When you talk about a society that cares for itself, this is how it used to work. We still live in a fairly philanthropic society for in some ways, and I would challenge you all: find a local charity, spend less on your gifts for your family, and give some funds away. I know that's what Tanya and I are doing, and you know what? I'm going to encourage you all to do the same. All right, let's move on to the dollar. The U.S. dollar, as I've been talking about, as the dollar goes, so goes lots of things. So goes gold, so goes commodities, so goes the stock market. As the dollar has gone up, which we saw it spike back in March when the pandemic hit, and I'm trying to pull my screen up here, it spiked on March 24th. The dollar peaked at 102.99. It closed today at 90.98. So if you look for the month of November alone, the dollar dropped from 94.12 down to 91.99. That is a decrease of 2.2%. Year to date, we're down 5.7%. Opened the year at 96.47. Again, we closed today at 90.98. How does that impact things? Well, crude oil year to date is down 23.9. You say, Craig, there's no inflation. Remember, oil went to zero a couple months ago, so it's gone from down 100% to only down 23.9. That is a big deal. Natural grass is up. Natural grass. Wow. I'm not smoking grass, I promise, okay? I like the smell of fresh cut grass, being a former football player in the fall. I digress. Anyway, natural gas is up 20.79. Propane is up 33.24. Let's get to our metals. Gold is up 20 spot 36. Silver 32 spot 68. Let's get into the commodities. Soybeans. This is why your groceries are more expensive. Up 21.25. Wheat up 8.35. Tea. For you tea drinkers, if a spot of tea is up 16%. Cocoa is up 8.49. Love dark chocolate. It's healthy for you. That's why I eat it. Lumber on the real estate side. Housing, new housing. Lumber's up 96.7. Help me understand building a new house, buying existing. That's why inventory levels are down. People are looking at building going, dang, it's expensive. And it is, okay? Rubber's up 33.5. Oats are up 15.6. Sugar up 9.7. Orange juice for you OJ fans up 21.7. And canola oil is up 25.8. On to livestock. Beef's up 19.8. 19.89. Poultry up 17.2. Other industrial metals, copper up 25.2, steel up 17.58. We're seeing inflation, okay? This is what is going to happen as the dollar continues to go down, and it is going to on the near term here. So what are we doing? We're shorting the dollar, we're buying commodities. Teeter totter, short dollar, buy commodities, okay? On to global macro. What this means is, you hear me talk a lot, there's always places to make money, regardless of what's going on in the economy. I believe that. That is what I try to execute every stinking day. We execute a data-driven process that is predicated on math. It is not predicated on emotions. Right now, what is happening? We are in an environment that I will call reinflation. Ooh, you say, what is reinflation, Craig? Well, reinflation is when we have growth starting to accelerate and we have inflation that is rising. They are happening simultaneously, okay? Another thing that I talk about in global macro, it's kind of like when you're a boat where you cannot change the direction of the wind, but you can adjust your sails. That's what you have to continually do as an investor. Is it hard to do? It's very hard to do. But you know what? It's something that I think it's the most time-tested, proven methodology for navigating the changing in the economic cycles, okay? Everything is cyclical. You know, things go up, things go down. Things are cyclical. You have to be able to invest through an entire market cycle. That is the kicker. Okay, is it foolproof? Absolutely not. But it does better than looking at things like valuations, like moving averages, which are garbage, you know. They don't work. Although people talk, oh, I think the market's a little rich now. Well, okay. Has that prevented the market from going up here? No, it has not. Okay. Here's my thoughts on this. Right now, what the data is showing is that we are going to see a continuance of this market move to the higher side, most likely through the middle of next year. Now, can that change? Absolutely, and it will. But I'm saying the data is today, and that changes every day, so this thing kind of moves. It's not drawing a line from point to point, which they call a secant. For those of you in calculus, if you remember that term, all right, which many of you have probably blocked it out and going, oh, geez, I'm going to have stinking nightmares tonight, Craig, thanks. The secant is a straight line. The economy and life, I promise you, is not a straight line. It's what happens in between. That is called rate of change. That's what's happening. That's the math component of what I do and what I focus on, all right? That's what is happening. So you say, well, in an environment like this, what are things that work? Well, best asset classes, commodities, equities, and credit. What is credit? That is corporate debt, both both investment grade and also junk high yield credit. If you look at also currencies, not the US dollar. As the US dollar goes down, what's happening everywhere else? Yen, Deutschmark, pound, the Chinese yuan, I think that's what it is. Oh, yuan, yeah, whatever. I know I'm digressing here. All those are going up because the dollar is going down. Worst asset classes, fixed income, specifically treasuries. We haven't owned treasuries in a couple months. Why? Yields are going up, and if you've owned treasuries, you've gotten hammered. Okay, and you don't want to own the dollar. Equity sectors, top sectors in this order: tech, consumer discretionary, industrials, materials. Okay, worst sectors: telecom, utilities, REITs, consumer staples. If you look at that and you look at how these companies are performing in those areas, it is exactly spot on. Best equity styles are looking at secular growth, looking at momentum. Momentum, you got to love that growth. Small caps. If you look across our models now, if you look at your statement when you get it or when you just received it, you're going to see a theme. What are we overweight? Small caps, large cap growth, tech, emerging markets. That's where you want to be. Okay, that's where you want to be. Moving on here. On the international front, this is not just a US thing when I talk about how we're seeing reflation. This is happening globally, people, okay? About the only places where we're not seeing a lot of growth, Germany, about ready to get killed. They're going into lockdown again, okay? France is another one, a little bit of a struggle. Spain, another one. But, there are other parts of Europe. Asia's ripping. China has been ripping, okay? India has been ripping. Japan has been ripping. Those are great places to look, and for the foreseeable future, we'll probably maintain that trajectory and that pathway. Where we really need to be thinking is mid-year sometime next year. My bet is, again, probably some form of stimulus package before the end of this year, probably another one after Biden gets inaugurated, okay? They're going to want to get off on the right foot and suck up to everybody that got them into office. That's what everybody does. I'm not just saying this because Biden got in there. They all do it. Why? You got to press palms, right? You got to press palms, got to shake hands, kiss babies. Why? Suck up to the people that got your butt elected. That's what's going to happen. That's what's going to really carry our market forward. So you have a declining dollar, you have stimulus, you have the Fed that says they will do everything. You know what that means? Markets up. I know that feels uncomfortable now. I've talked to several of you here lately about the rebalancing, and you're like, wow, that's a little aggressive. Understand the data has to drive it. Moving on to my last topic here, okay? You have to have a data-driven process. You cannot do it with emotions, of which I wear mine right here. If you talk to my wife, anybody that watched me play baseball or football knows there were times I was a stinking disaster. Why? Red hair, explosion. Craig would throw bats, helmets. It was ugly. Passion, okay? It's emotion. You can't invest that way. You can't live that way, all right? Another one, valuation. Valuation can't be an only metric. Lots of people, I look at the PE value. That's garbage. You can't just use that as your only metric, okay? And you can't use it at all because it's not a time proven. You can back test that. Valuation doesn't do it. Same with moving averages. That's like looking behind you and trying to drive your car the other direction without a rear view mirror. Bad idea. Bad idea. Okay. Do not try that at home. I'm telling you. Okay. So lots of good stuff today. All right. Keep your eyes focused on what is in front of you. It's not what's going to happen. Tune that garbage out. You have to play the hand that is in front of you. It's like playing poker. Now, I'm not saying that investing is like poker. It can be, but I'm saying it from an analogy. You play the hand that's in front of you. It's like as a quarterback, and I would go up, and they had this thing, they called it a pre-snap read, which when I got up, before I got under center, what am I doing? First thing I would look at is the defensive line and their placement. Secondly, I would look at is the linebackers and their placements. Thirdly, I would point out where's the strong safety and then look in the secondary on where they're placed. That is called a pre-snap read. That is called playing the hand in front of you. That's what we are going to do today. That's what we are doing tomorrow. That's what we are going to do every day. That is the safest way to travel. It is the only way to travel. Love you guys. I missed you. I hope everyone had a great turkey day. I hope you've recouped enough to get ready for Christmas coming up here. Ski season. I'm going to ski with my son this weekend. CJ's driving home today. Pray for his safe travels coming home. We've got a few slick roads out here on the interstates, but they're not too bad. But he and I are going skiing Sunday, so we're going to check out Winter Park. So I'm kind of fired up. It's ski season, and I love it. I love it, love it. So anyway, for Friday, December 11th, this is Craig Modelmog for this week's Wall Street X's and O's. I love you guys. Thanks for tuning in. And until next week, I love you, and I am